The Reserve Bank has surprised the markets and most economists by keeping interest rates on hold at 3.85%. The market was broadly expecting the RBA to cut interest rates for the third time this year, which would have taken the cash rate to 3.6%. Instead, interest rates have remained at 3.85% after previous cuts this year in both February and May. The RBA took the cash rate up to a peak of 4.35% after the post-COVID period, where it held since the end of 2023, before the RBA first cut in February this year. So it is a surprise to the broader market watchers that the RBA has kept the interest rate on hold at 3.85%. It was widely expected to cut on the basis that inflation, the underlying rate of inflation and the headline rate of inflation, were within the RBA's target band, with the underlying inflation falling to the midpoint. But of course, we do have a very strong employment market, with the unemployment rate holding at 4.1%. And perhaps the RBA is waiting for more information, like the quarterly reading on inflation, which we'll get on July 30, before taking a decision to cut. So we'll bring in now Jarden Chief Economist Michaela Ficilla, who is standing by for us. Michaela, quite a big surprise from the RBA today, if you've been reading all of the commentary leading up to it.
Yes, the market was actually pricing almost a full cut, and we were expecting a cut as well. Knowing that the risk for this particular meeting was that data has been mostly mixed. So we had pieces of data that were quite nice in terms of the inflation outlook, like the monthly inflation indicator coming down to 2.1. We also had a labour market report that, even though it's still really strong, it showed a little bit of job losses throughout the month, particularly for part-time jobs. And we also had all the measures of confidence being a bit mixed. So the combination of those, plus the RBA's guidance that they're willing to ease rates as they're more comfortable with inflation, led everyone to think that another cut was very likely. But I am as surprised as the market, perhaps.
Now, when we look at the people most affected by rate cuts, of course, we have savers and we have those trying to pay down a mortgage. We talk about those as the opposite sides of the coin, if you like. Is it a win for savers today?
Not really. I think the guidance from the RBA hasn't really changed. So we would expect them to continue to ease as they see the data evolving. As you said, eyes will be on the data on inflation. So it's perhaps a slower pace to easing, but what savers and mortgage holders will care about is where the rates end up by the end of the year and how much relief the cash flow gets from that. The interesting part of this meeting is this is the first time the RBA publishes detail of what was discussed in terms of the members voting. So for this particular meeting, it wasn't really an unanimous decision. There were 6 people who voted to keep rates on hold, and other 3 who said they were expecting a cut. So this is a new thing for the RBA, and it's important to highlight that now we're getting more transparency on how easy for them is to take these decisions, especially because we are under a lot of uncertainty on the global economy as well.
And of course, the market is pricing in, or had been leading up to this meeting, 3 cuts this year, including one today, which hasn't materialised. What's your view about how many cuts we could get ahead from here?
So we expect another cut in August and another cut in November. We think the RBA has enough scope to bring rates lower, but that doesn't mean that the cash rate will become accommodative. So it's just coming back from really, really high levels that we saw over the last couple of years. I guess the pace on where we're going to get there is very questionable and very much linked to global developments and developments in the labour market. So we still coincide with the RBA's assessment of the labour market. There's still some strength there, and perhaps cutting too fast is a bigger risk in terms of bringing inflation back up. But in saying that, our view is still for at least 2 to 3 more cuts this year.
And it's interesting you talk about the fact that we now have some transparency around the votes on the interest rate decision, but we don't know who voted what. We just have the numbers. Do you think that the global picture is playing into this? The RBA would like to keep its powder dry?
Yeah, so the minutes from the latest meeting actually assess the uncertainty around the global highly unusual. So it's very hard to tell where that uncertainty is flowing through the hard data or perhaps those survey indicators in the private sector, particularly for the US, because we have seen labor market data in the US holding up okay. We have seen inflation remaining contained, some volatility around imports and things like that, but we haven't really had a clear indication on where the economy or when the impact is expected to be seen. In fact, there's also no clarity around the impact of tariffs on inflation, if this is going to be an inflationary shock or if it's going to be more a response or to slower growth on the back of businesses not knowing what to do. So I guess that's going to become a little bit better in August when we see those deadlines or after the 9th of July being released. But it's just really uncertain. So I guess the RBA has the choice of a lot of meetings left this year to decide what's coming up and a lot of more data to be released ahead of the next meeting as well.
Yeah, very quickly, Michaela Ficilla, what's the next flashpoint for the RBA? If people are waiting on RBA cuts, what would they be looking out for?
Perhaps the labour market data mid-July, just after this meeting actually, and the main CPI quarterly report at the end of the month.
Michaela Ficilla, thank you so much for your quick insights. We appreciate it. So, Ros, probably some fairly disappointed home borrowers, a handful of economists getting the call right, but the broad majority of market watchers probably very surprised by the news that the RBA has kept rates on hold at 3.85%.
Absolutely. Well, let's go to the RBA now, where our business correspondent David Taylor is standing by. Hi there, David. So as Alicia was saying, the RBA has surprised a lot of people here. You've had a chance to read the accompanying statement. What stood out to you?
G'day, Ros. And look, no doubt there are Treasury dealing rooms right around me in the city at the moment. I can assure you that currency desks will have, you could probably hear the typing from here in terms of the shock that would have gone through the system there, because the Treasury departments of the major banks would have most certainly been leaning or leveraged towards a Reserve Bank rate cut. And the statement is pointing to the fact that it's the labour market that is holding the Reserve Bank from further cuts. And what I mean by that is that at 4 or 4.1%, which is where the unemployment is now, it's a relatively tight labour market, and you could argue it's actually full employment. So, and the Reserve Bank was expecting it to creep up to around about 4.5%, so we're well below that. But it means there's money in people's pockets. You also have Fair Work decisions on minimum and award wages, which has lifted wages. Again, more money in people's pockets to spend. So what the Reserve Bank has said in this statement is we're just not sure about the outlook, it's uncertain, and we're not sure where aggregate supply is in terms of aggregate demand. Now that's a little bit of jargon, but what the Reserve Bank is saying is we don't know whether there is upwards pressure on prices in the economy because lots of people are employed and lots of people who have money, or there's not. Previous rate cuts have had mortgage borrowers put that extra money in their pockets and not spent it. But there are so many people employed and so many people looking for work that are actually landing jobs, the Reserve Bank is just a little hesitant to ease monetary policy and put even more money in people's pockets in cases that push prices up. But the other thing I have to mention is productivity. Now, productivity based on the latest national accounts is actually negative. So when productivity is weak, if you get strong wages growth with that, then that tends to push inflation up. So the combination of a fairly tight labour market with low levels of productivity is making the Reserve Bank nervous about what would happen if it cut interest rates. At the same time, there is a case to cut interest rates because that monthly data is showing that inflation has eased. In fact, it's beaten the Reserve Bank's midpoint target already. Again, what I'm expecting Michelle Bullock, the Governor of the Reserve Bank, to say at the press conference just behind me very shortly is that the Reserve Bank is waiting for that June quarter inflation read to be confident that another cut is worthwhile.
OK, so from what you've seen in the statement that you've read then, David, any clues in that as to what the Reserve might be planning to do next month and beyond that?
Well, again, not really. I mean, if I search down to the last paragraph, the bank has said that it will be attuned to the labour market and the outlook for inflation, but it's always said that it will be data dependent, which is a little confusing because if you look at labour market data and indeed inflation data, you're looking in the rear vision mirror. And historically, the Reserve Bank has used art and judgment in its interest rates decisions. Indeed, it's looked at forecasts and surveyed businesses and consumers and thought, you know what, I don't think that the economy can stand on its own in the next few months, so we're going to cut rates, or the opposite may be true. But the Reserve Bank, because it has been so hurt, I guess, in the past by the media and public opinion, rather than making that judgment and forward guidance, it relies on the data. So what that means is it is very unpredictable what will happen in August and indeed beyond that, because the Reserve Bank will be waiting for that June quarter inflation print to show that inflation is not just within the 2 to 3% target band, Ros, but it's sustainably within that band.
Okay, there's also a focus, as Michaela Fucillo was telling Alicia, on labour figures. They're coming out in the middle of this month. We'll keep an eye on those, of course. David Taylor, thank you.